Hey guys, welcome back to the channel. My name is Valentin and I hope you're all having a wonderful day. Now, I'm sure at some point in your life, you or your parents have gone to a bank and have asked for some financial advice on where to invest your current savings or how to create a retirement portfolio. And more often than not, most investment advisors or brokers, they would recommend that you purchase their mutual funds or exchange traded funds. So in this video, I decided to do a quick comparison of the mutual funds and the ETFs available through a number of banks in Canada, such as CIBC, TD Canada Trust, BMO, and I believe Scotiabank. And this way I can show you how good are these exchange traded funds, for example. So how do they fare against each other? And are they really a good buy? All right, stay tuned, let's go in. All right, so for this video, we're going to focus on Bank of Montreal and in particular on the exchange traded funds available through BMO. Now, I picked the ETFs because if you watch my previous videos, these tend to have lower management expense ratio than mutual funds and tend to have equal or higher profitability. If there's a lot of interest in these videos, I'll also do mutual funds. If not, we'll just stick to ETFs and we'll do a multiple video series where I'll cover one bank per video just to keep them shorter. So on my page, I have a number of ETFs that are highlighted in 4 different portfolios by BMO. So the income portfolio, diversification, growth, or stability based on each investor's sort of target gains and risk tolerance. So I'm going to take the first 4 ETFs here, use the ticker symbols, and then go to TD Web Broker. This is a tool that I use from TD Canada Trust. I really like the sort of the mutual fund or ETF comparison tool they have here. So I'm not sure if this is free for everyone. You might have to have an account with TD to use it. So I've taken the tickers and I've put them in this comparison tool, and this is what it generates. So let's quickly look at how good these funds are. And the first tab, the summary tab, we had the 2 important metrics here are the fund category. This is just a general kind of description, and then the MER is the management expense ratio. So for ETFs, MERs that are under 1 are of course ideal. However, knowing that there are a number of ETFs that have management expense ratios with 0.01 or 0.03, so much cheaper, these are considered, in my opinion, a bit expensive for an ETF. In comparison to a mutual fund, which charges 2, 4, 5% or more, are cheap. But when compared against ETFs, I would say these are expensive. The distribution yield is basically how much fixed income you get by holding this particular ETF, and they can be paid on is it monthly, quarterly, semi-annually, or annually, depending on the ETF. And these numbers are not too bad, considering these are bank ETFs. I would say they're decent. They can get much higher, of course, depending on what you own. So let's move on to the performance to see how exactly these did against each other and just in general in the market. So you just click on this. And for performance, you have multiple metrics. I decided to look at 3-year and 5-year because this kind of gives you an idea how this fund managed to kind of perform throughout periods of volatility in the markets as well as stability. So practically, if you look at the 5-year metric and you have a very high return, it means that on average per year, you're making this particular return. So if we look here, the first one, it's pretty low in both 3 and the 5. Same thing with the second. The third has pretty good returns, 15.3 in 3 years and in 5 years. That's the average return per year. And then the last one, it's not as good. So the third one kind of sticks out in terms of performance. Okay, so let's look down at the risk metrics. In this category, I would look at 2 in particular, the beta and the alpha indicator. The beta indicator is practically a measurement of market volatility. If you are above 1, like in this case, your ETF tends to be more volatile than the market. That's not necessarily a good thing. If you're under 1, you're less volatile than the market. So that's kind of what we want. And as we can see, this third one here has a 0.59, so that's much less volatile in the market. So that's good. And the alpha indicator, as I mentioned, this is an indicator of performance. So what it means is if you have a positive alpha value like this, it means that this particular ETF, they outperformed the benchmark index for its category by 8.85%. Whereas if you have a negative values, like in these cases, these underperformed compared to the benchmark index by minus 2.88. So for example, let's say if you have a tech stock like Tesla, benchmark index probably that will get compared against something similar to S&P 500, or I'm not sure there's a particular tech index, but that's kind of how it works. So you want to have a positive value here, the higher the better. So again, for the third ETF, it wins in the risk category as well. And then you have holdings allocation. It just shows you kind of where most of these the stocks under the ETF are invested in. So for the third one, we see it's all pretty much mostly Canadian equity, a bit of US, a bit of international, and yeah. So these are the main metrics that I would look at. And just to double check quickly on what that particular ETF is, just to look into the details. So it was the third one, the ZUT. I believe that's what it was. ZUT. You can go to Yahoo Finance. So this looks like it's a BMO equal weight utilities index. So utilities are things like gas, electricity, water, and these particular companies tend to do well in periods of recession and less well when there's exponential market growth. So if you look at the 1-year graph, since January, it only increased by, well, and it's not too bad, but the 5 years where I was telling you guys, so from 2018 to now, from 15 to 26, so quite a bit of an increase. And you've already seen these metrics that I've described. Let's look at holdings. So it's all stocks, all utilities are pretty much 99.27. And these are some of the companies that are under. And performance, 28 1 year to date, 28% year to date. So that's really good for this year. And you saw the 3 and the 5 year. Now, if you look at the annual returns, you see in 2018, it actually, in one of the market crashes, ironically, it actually went down here, and 2015 as well. However, if you remember the annualized returns, they're basically adding, to calculate the 5 years, they would do the 28.6 plus 35 minus 7.9 and so on, divide by 5, and that will give you the annual. So despite that you dropped in some of these years, it easily makes up into the others. Okay, so let's take on the growth portfolio. Now, the income portfolio was mainly focused on the dividend yields, not so much about growth. So even though we saw in that third one, we were able to get 15% per year, which is not bad at all for a dividend-focused portfolio. The growth portfolio is the one that's supposed to generate the most amount of money, I guess. And this is not focused on the actual dividend. So let's see. I'm just gonna take this off, make this a bit smaller. I'm just gonna put the ZMT, ZEO. See what these looks like. ZQQ and ZJO. ZQQ. Did I misspell that? ZJO. I wonder why that doesn't appear. BMO Junior Oil Index. For some reason, this one doesn't come up. I'm not sure, so we're gonna focus on these three then. All right, let's say to compare. MERs, very similar to the previous portfolio that I've looked at. Distribution yields, well, quite a bit of a difference here, but we can see the second one. So the oil one has 6%. So this is actually even higher than the fixed income, high dividend yield, the ETFs that I previously covered. So interesting, we'll keep an eye on it. Let's look at, actually not the profile. Let's look at the performance of these. So the 3 and the 5 year. The first one, I'm automatically seeing a lot of volatility in these. And the first one, 3 year minus 5.7, 5 year 10%. I don't know. I don't like this at all. The second one, it's out of question. It's all negative in the 3 and the 5. The third one is the clear winner. So here we have 43% in 1 year, 23% over average return yearly over 3, and then 20%. So this actually performed much better than any of the other ones in the first portfolio that we discussed in the high dividend yield. In terms of risk, remember the beta is the market volatility. So having a beta higher than 1 means you're more volatile than the general market, but not by much in here. And then the alpha is, if you're positive, it means you outperformed. If you're in the negative, you underperform. So this one clearly outperformed the market, slightly more volatile. It's expected. In terms of assets, it's all in the US equity, 97%. And BMO, NASDAQ 100, ZQQ is one that I've invested in the past too. And it's a fairly good performing ETF. We can check it out right here. So these are massive returns, 36.7, 2018 in the crash, you went down by 1.85, and then 31% in 2017, 6.4. So lately it's done really, really well. And I believe it's high on the tech stocks. If we go into holdings, consumer, healthcare, communication, technology, yeah, so 44% technology companies have done really well in the past few years. We have Apple, Amazon, Microsoft, Facebook, Tesla, NVIDIA. Yeah, so this is why this fund did so well. All right, so that was the growth portfolio. Now in diversification. So this looks like it's a mix of stocks with bonds, kind of to, and then I would say Canadian markets, international markets, US, the emerging markets and developed markets as well. So it's kind of got a bit of everything. So the performance of this should kind of be in between the first two, I would say. So ZHY, ZDF. All right, so let's try these out. I'm just gonna close, and go back. ZHY, ZDF. We have to see if it finds it. Yeah. ZDF, ZCS, ZXD. I don't know why it doesn't find certain ones. So ZXD doesn't find, I couldn't find it. Okay, so we're just doing these three then. So hit the compare here. MERs, similar, this one's the cheapest at the end, and it has a 5-star Morningstar rating, which is fairly nice. Distribution yield, high dividend in the first one, the lowest for the last. Still not too bad. It's really nice to have any sort of ETF portfolio that gives you a yield to around 3 or more. That's great to have. It's better than none. So in terms of performance, 3 and the 5 year, they're all relatively the same, fairly low performance. Again, remember that I said this is a diversified portfolio. This is what happens when you throw in bonds with the ETFs, and I think it's pretty heavily loaded on the bond side. All the numbers are going to be like this. You're not going to get anything above 10%. So this is expected. This is all positive. In terms of risk, the risk should be lower in overall than other portfolios because you're very diversified. So let's see in the beta, and the beta, it looks like the middle one is the best bet. That's the least volatile compared to the market. However, the alpha shows that it slightly underperformed the benchmark index. In fact, all of them underperformed. But this one only by slightly. However, this is much more volatile. So between these two, it would be, I think, either one. This is less volatile, but it underperformed the market much more than this one. So in terms of equities, fixed income, 99.7. So this is pretty much, majority of these is probably bonds. Whereas in this one, you have only 81% bonds and then 17.98 other. I'm not sure what that is. So that's what a diversified portfolio looks like. And then let's just quickly look at ZCS, ZX, ZCS, that's the third one. So bond ratings, AA, okay, and that's not what I wanted to look at. Stocks, bonds, 81.58. And it shows here some of the top. So these are bank bonds, which are fairly good. And then let's look at performance. Yeah, at least it's in the positives, but again, these are supposed to be fixed income. So you're looking at the dividend yield. These are meant to kind of prevent your portfolio from crashing in a time of instability. That's when the bonds shine most of the time, and it gives you that little bit of income despite markets suffering or underperforming. Now, the last one is stability, and this is very similar to the previous portfolio because I'm seeing here low volatility, short federal bonds, provincial bonds. So I'm not going to run these through again because we're going to see a very similar thing to the diversified portfolio. And I think in terms of like a young investor, the first two portfolio here are a bit more interesting if you're looking into getting that extra income from an increase in the markets. And I think in 2021 we're expecting to see similar trends as in 2020, as in there definitely is room for growth, especially in these industries of renewable energy, in the healthcare sector, biotechnology, and any other technology companies. These sectors are expected to do well as well. So I hope you found this video informative. And in the next video, we're going to look into some of the ETFs available through TD Canada Trust and see how they fare in comparison.